Hi, everyone. Good afternoon, and welcome to our Intro to Angel Investing Workshop, session number 3 with 1000 Angels. I am really excited to be broadcasting live to you guys from the beautiful Pelican Hill Golf Club and Resort in Newport Beach, California. So, sharing a little bit of this gorgeous weather with you guys as we get things started today. So, we're going to pick up where we left off at the end of session 2 from last week. If anybody is new to the webinars, you can always watch our previous session 1 and 2 recordings on YouTube. We keep all of the sessions there in case you can't make one of the days. So just to introduce myself to anybody new, my name is Erica Diegnan. I am founder and CEO of 1000 Angels, where we help accredited investors build a portfolio of early stage, high growth, direct private equity investments. So if that's something that you're interested in, please check it out. And you can sign up for a free 2-week trial at any time on 1000angels.com. And we provide a monthly investor training, which I run every, I think it's like the last Monday of every month, to help folks kind of understand a little bit better how we select investments, the process that it actually takes to go from meeting a company to, them being profiled on 1000 Angels to them actually receiving an investment from us and our wonderful network of investors. Great. So today we are going to be starting with one of my favorite topics, and that is called investable deals. So I will be sharing my screen with you here. Great. So that everybody can see these lovely slides that we have. So this is actually a really, really important topic to discuss, and we'll kind of go through it quickly. But there is a huge difference between a company that is a good idea, right, a product or service, or even a business that's a good idea, and what makes something actually investable. So just because, a friend of yours or a cousin, a relative, whoever it might be that's coming to you for money, has what we might describe as a really compelling idea or opportunity, or even a business that makes sense for them, it's not necessarily always what we call investable. So I would give you an example of something like, somebody who is a doctor and wants to maybe go into private practice and, run their own business. That's a wonderful business opportunity. For example, my mother is a physician and she has her own practice, but it's not necessarily what we would call an investable deal, because the majority of the cash flows that are generated from a business like that actually go towards compensating the staff that's working there from day to day, right? So what we're really looking for are deals that are investable from the sense that the value of the retained equity within the company can continue to grow, and eventually one day the business might be acquired and we'll be able to actually get a return on our investment. So what exactly is it that makes a deal investable versus not investable? And, these are sort of the criteria that you'll be able to use sort of when, somebody comes to you with an idea that they really like, but it's not a good investment for you. You can sort of explain to them, hey, you didn't meet these certain criteria. Here's why it's not the right investment for me at this time. So some of the things that we are definitely looking for in an investment, number one, there has to be a really strong management team. So, a lot of times you'll get folks who are solo founders, solo entrepreneurs who want to come and raise money from you. This is really actually, unfortunately, a big kind of, not necessarily a red flag, because the person can still be wonderful and amazing. But the reason that we look for a strong management team is that, a founder is not there to do everything and run the business soup to nuts, right? So the founder or the CEO usually one and the same, they have to have a variety of skills, which includes being able to motivate other people to work for them in order to actually grow the business to something that we can exit. So if, by the time they're coming to you looking for funding, they've not even yet been able to rally, a management team around them, it's a pretty good indicator that they might not have, or they might not yet have the chops that are needed to actually grow a big business, which will probably involve, hiring a decent number of people and inspiring them to really get behind your vision. So a company that has a strong management team shows us that the founder or whoever came up with the initial idea is charismatic enough and compelling enough to be able to get other people actually really excited by the prospect of working on this business for what is probably at this point no money. So that's a really good sign. And we know that, the business is not completely reliant on the skills and activity of just that solo founder, but there are more people who actually believe enough in the opportunity that they're willing to put their own sweat equity into the business by coming on as management, before the company's even really funded. So that's number one, strong founder, strong management team. The next thing is really, you got to have a strong marketing plan. This is one of the most crucial elements that a lot of founders and investors don't pay enough attention to, right? So we've got to figure out, okay, do we understand who is the company's customer, right? And that can be an enterprise, it can be other businesses, it can be consumers, but we really have to have a very clear idea of who they are and how the company is actually going to reach them and convert them into clients. I see so many businesses, when they're pitching, spend, 99% of the pitch talking about their product. And of course, having a wonderful product is great. And, we want all of our startups to have a wonderful product or service. But really, the trick isn't creating something amazing, it's creating something amazing and being able to get that into the hands of your consumers and have them be really thrilled and continue to buy more and continue to recommend your product or service to other people. So, a strong management team has to be followed up by a very strong marketing plan. So, once you have an idea of what the product or service the company is providing or producing, make sure that you really dive into their marketing and distribution strategy so that you can completely understand the viability. And so one of the, sort of mathematical metrics-driven tests that you typically use as a rule of thumb, and remember, this is just a rule of thumb. It's not, something hard and fast because it also has to do with timing of the cash flows. But generally what we're looking for is what we would call a CAC is, basically less than a third of your customer lifetime value. And so what we call CAC, CAC, is just your cost of acquiring a customer, or it could be referred to as customer acquisition cost, either one you like. And CLTV is customer lifetime value. So that's sort of the total amount that the customer is going to be contributing to the bottom line over, the course of using the product. So let's say, that you are selling, sort of maybe a subscription service, right, that doesn't really have, most of these software technologies don't really have much marginal cost. And let's say, that the subscription is $10 a month. That's pretty typical subscription price for most consumer technology products. And let's say that usually your customers, stay subscribers an average of 6 months when they sign up. So when you actually get a new consumer, you can expect that they're going to pay you $10 per month for an average of about 6 months. So that's $60. So by this rule of thumb, as long as the customer acquisition cost, the cost of acquiring a customer for the business is $20 or less, they're basically meeting the target. And, it essentially means that they're going to recoup the amount of money that they invested in acquiring that customer within 2 months or so. So it minimizes the risk of actually going out and acquiring new customers. So, although the general rule is that your acquisition cost should be 1/3 or less of your customer lifetime value, the amount of time it takes to recoup that money is also important. So, for example, if the subscription were only, $2 per month, but, the customers were actually going to, end up being customers for 30 months, you would still meet the rule by investing $20, but it would actually take the company 10 months in order to recoup the investment. So from a cash flow perspective, you're basically not in the money for almost a year, and it can create a big cash drain on the business. So we want to obviously think about, the absolute dollars, right, when we look at this equation, but also the length of time that it takes for you to actually break even is also important. So the faster that you're able to recoup your the cost, whatever cash you had to lay out to acquire a customer, the better. So that's another really important thing to look at. And then another thing when we're looking at market, really the company needs to have what we call an addressable market of at least $1 billion. So what we mean by addressable really, is the way of saying, the customers that they're actually going after, right? So if I'm, starting a new company that is making, swaggy golf t-shirts, right, for conferences, I might say, well, the overall market for clothes is, whatever it is, $100 billion, right? And that's great. The overall market for clothes is $100 billion. Or you might say, well, the market for golf t-shirts is, $10 billion, right? And that may be true, but that's still not my addressable market. They would actually have to say, what is the addressable market for, women's golf shirts that are being given away at conferences? And, that might end up being $1 billion. So would still, maybe fit into our criteria here, but you can see it's much smaller than the original amount. So you have to make sure that you're really looking at what is the company's actual addressable market. And, if the total addressable market is only, 100 million, the deal is now not really investable. And the reason for that is because it's going to be very hard for you to find somebody to acquire a business that has a total addressable market of $100 million. And the simple reasoning behind that is that typically, companies might become viable acquisition targets by a larger enterprise or maybe private equity. Generally, you have to, I would say around the time you're getting to kind of like $100 million, in annual revenue, maybe 50 million. So the point is, even if at 50 million you were interesting, the reason that people want to acquire your business or acquire a business is so that they can now take it and scale it much larger, right? So they can penetrate the market more fully in some way because they've got additional resources, et cetera. So if you've basically already pretty much completely penetrated your addressable market, by the time you get to 100 million in revenue, you're less desirable as an acquisition candidate because you would not necessarily be driving growth, and that's what most acquirers are looking for. Now, it's a slightly different thing if, you are, say, like if we take Facebook, for example, this is a really good example of a company that started off with a niche and then was able to really expand its addressable market in a very smart way, right? So they started off with with a service that was just for students at Harvard, right? Then it became, and that's a very small market, then it became just for students in the Ivy League. Then it became, just for kind of, college students at these sort of select East Coast colleges. Then it became just for college students, right? And then I remember I was actually like doing my MBA, I think, or had just done my MBA around the time that they launched. I think it was like, actually, no, I was probably a couple of years out. And, we were all excited because, all of a sudden now they had opened it up to anybody with a .edu address. So, grad students were now also allowed on Facebook. So then it became, just anybody with a .edu address. And then it became, everybody and their grandmother and their great grandmother and everybody on earth. So, even though their addressable market started off very small and very niche, it eventually got bigger and bigger and bigger. And so if the company has the ability to do that, you should be aware of that potential. But if that's not a potential, you really need to make sure that the addressable market is at least 1 billion. So moving on to the next slide, we are also looking for what we call a scalable product and business model, right? So the best example of scalable products might be, some sort of an app, right? So, generally, once I create an app, get it into the App Store and start marketing it, it's just as easy for me to have 100 people download the app as it is for me to have 100 million people download the app. So that's what we mean by scalability. An example of, a product or service that's not so scalable, would be, and I'll give an example of a company that I actually really, really loved that went out of business because of scalability issues. I don't know if you guys remember a company called Kitchen Surfing, which seemed like such a great idea. It was basically Uber for private chefs. So, if you, were either like a very fancy person who was just a little bit too lazy to cook, or, in my case, maybe, you were having a special dinner party or something. And so you were actually going to splurge to bring in a private chef, which actually wasn't a bad deal because, per person, it ended up being far less than actually going out to dinner with 10 friends just to have them come over to your home and have somebody else cook. So this is a great example of a really fantastic product or service, right? Which seems like there's a big market opportunity. Who wouldn't want to have a really amazing chef come over to your house and cook for you and, clean up so you can have a dinner party without all of the stress and headache of shopping, preparing, cooking. You can actually just enjoy yourself. But unfortunately, the business wasn't very scalable, right? Because, for each additional customer you have to bring on, you've actually got to go out and find a chef, right? So each chef that you bring onto the platform can only really service so many customers, right? Because of, time constraints and, they can only work with one person at a time. So, this is a really great example of, a situation in which, the company had a great team, had a great product, customers loved it, but because of a lack of scalability, it didn't really work as a business. So, being able to sort of see those things in advance, even when you think, oh, this is so cool, really helps you to kind of be a little bit more disciplined about your investing strategy. The next thing is that there really should be a product that's in market or extremely close to being in market, like they're in beta. I would not recommend, investing in somebody who's like got an idea. The absolute worst, to me, the worst red flag are people who are like, oh, I'm going to do X, Y, and Z. I'm going to create this such and such app. And then they want you to invest and you're like, what are you doing with the money? And they're like, oh, we just need $250,000 to get, some outsourced development place to develop it for me. What? No. Okay. That is not the type of thing that you should be investing in. If you hear, somebody pitching that, you got to run for the hills because, basically, they want to take your capital to have, somebody else build their idea for them. That is not the time at which you should really be coming in. It's one thing if somebody's, kind of already done some sort of like a minimum viable product test. They've really validated the market. They've built up a customer list, and now they need to have money invested in development. Totally different situation. But for people who, don't have a product in market, even if it's with, what we call sort of the Wizard of Oz strategy, right? Where there's like nothing really behind the curtain, but they're making the product operate. This is not the time for you to invest. A really great example of this, and this is like, I've probably told this story on video before because I'm always like, kicking myself, but you guys have probably heard of a company called Stitch Fix, which IPO'd recently. I think they're valued at like 30 billion. Might actually be more. I think I don't know. It's some like ridiculous number, right? I don't know. I don't even know. I'll have to go look it up. I haven't been paying attention because I actually passed on them in their early stage. But one of the things that their founder did really well, and I believe she was out of Harvard Business School. So Stitch Fix is one of those services that was essentially created to kind of be like an artificial intelligence personal stylist. So they would help you get like send you a box with maybe like, I don't know, it's like 5 to 10 items or something that are supposedly, somewhat personally selected for you based on your tastes. And they send you the box once a month or once a quarter or whatever you pick. And then whatever you don't like, you send back. And one of the things that the founder did, which is really great, is that she had the idea for this product. And instead of, going out and begging somebody to give her money to like make an app or whatever, I mean, she literally just created an Excel spreadsheet, of people's names and emails, made an email newsletter, had people sign up, and just actually started providing the service, right? Without sort of all the technology back end built in order to sort of validate the model and validate the demand. So that's a great example of, somebody who maybe still needs to raise money to develop out the website or other sort of logistics or technology, but they've actually gone in and, created a way to validate the product or service, to get their product or service into the market and validate it before they actually start building a ton of things. So, perfect example. Another little story in there, I actually like passed on that company because I, loved the idea, but I said, oh, this is so cool. I would love that. Let me order, let me sign up and order a box. And I actually got the box of clothing and I was like, this is kind of like looks like a box of clothes from Target or something. Not that I don't love Target, but, not really like the type of quality that I would have expected. And so I was like, I'm not investing. And, that's another really great piece of experience, which is that, when you're looking at a company for an investment, it's not always so great to sort of try it out yourself and figure out whether or not it's for you. Because you might not be the consumer. Like I've definitely had companies that have grown very large where I haven't been the right consumer, either because the product is too low end, to be something that I would use, or it's too high end to be something that I would use. But in both cases, even when I thought, oh gosh, not for me, the companies ended up becoming very, very big and very, very successful because, they found their customers. So always make sure that you're not trying to like personally associate yourself with the product or service, but that you're really just looking at the business skeleton, right? So like, let's not look at the book by its cover, but really let's sort of like look at the bones of what the business are when we're making our decision on whether or not to invest. So the next thing is active clients or users, right? So, we want, if the product's in the market but doesn't have any users, that's not good. You want to make sure that at least somebody is actually using it. The next thing is that we generally look for barriers to entry. This can be helpful, particularly if you're looking at, things like the meal kit industry, right? Really great idea. Obviously, it's created a very successful industry, but a lot of the startups in there, they didn't have much, barriers to entry around new entrants coming into the space. And for whatever reason, like people were just super excited to create meal kit companies. I have to say, I was a little bit shocked by that, like the amount of enthusiasm there was for meal kit company creation. But I just felt like there was like a new one being started every week. Like I met so many founders, probably like when that space was really hot, maybe I guess it was like 3 years ago. I felt like, you couldn't, you know, swing a bat without hitting the founder of a meal kit delivery company. So something that has like some barriers to entry is definitely a positive aspect. So there's actually a company that we're working with right now that's in the process of a raise that's on 1,000 Angels, called Lux Beauty Club. And she basically is doing a really simple product, which is like she makes these really cool kind of clip-in hair extensions. So, if you have like a wedding or a fancy night out or, some fancy date or something, and you want your hair to be really fabulous and long, you can sort of clip in some extra hair and look, like a Victoria's Secret model's hair or something within minutes. And you would think, oh, what are really the barriers to entry there? Simple consumer business. But she's actually got exclusive access to the manufacturing and distribution facilities of hair in India, which is where like the highest quality human hair comes from for extensions. So while all of her competitors are out kind of getting, really disgusting, crappy hair from China that, the customers hate and have a terrible experience with, she's actually able to provide, get sort of exclusive access to this limited supply of extremely high quality hair that's actually donated at temples in India. So, that's a perfect example of something that has a barrier to entry that now adds value to the investment opportunity. And then the last thing, of course, that is here at least on this list, and there are so many things to think about, is a credible exit strategy. So from the very beginning, we're always thinking, who's going to buy this company? And just because we're thinking, there's sort of this weird stigma in investing sometimes. People say, oh, don't mention anything about an exit strategy of the founder. And it's like, no, actually, really, the point of us making an investment isn't for you to like create a family business and, have your, third generation grandchild as the king of the whatever this is empire. It's so that, the investors can get liquidity in 5 to 10 years. And that doesn't always have to mean a change of control. But generally the exit opportunities that are the highest likelihood is that somebody will acquire you. Certainly the IPO market, it seems like, some IPOs are happening again. So, that's a possibility that's kind of getting back on the table. Although you'll see, a lot of the largest startups that have now grown very large are still not going public. And you've seen a few IPOs that have done well. I think like Eventbrite finally just IPO'd, but I feel like that company is like at least 20 years old. So, it's taking a really, really long time for companies, to actually get to IPO or to decide they want to do it. And so M&A is, our most likely outcome. So you want to kind of be thinking as you're looking at the investment, what companies that are sitting on a lot of cash that are desperate for growth opportunities might pay an insane premium for this business. And if you can think of like 2 or 3 or 4 of them, then that's really great. If you can only think of one, not so great, just because, an auction with one bidder isn't really, that great for the person who's selling. But a credible exit strategy in general is something that is really important. Okay, great. And we've still got quite a few more criteria to go over. So next things in the list of things that we need to think about are clearly you want a very capital efficient business. So for this one, I always love to give the example of the company Zipcar. I don't know if I have all the numbers exactly right, but everyone has heard of Zipcar, right? It's a household name. The company went public. Now you would think that as the founder of a company, that everybody has heard of, that's a household name, that has had an IPO, you would probably be doing, you would have had a fantastic, it would have been fantastic for you financially, right? That's kind of the assumption. And, in the case there, it was sort of insane because by the time the company went public, I think the founder had been working at the company, CEO of the company, started the company. I think she came out with something like $10 million, which, especially if you live in New York City, right? $10 million for 10 years of just, absolutely emotionally heart-wrenching, stressful, type of work. And, having started a company that everybody's heard of and that went public and, you worked there for 10 years and now you only come out with 10 million bucks, is not necessarily the outcome that people would expect. And the reason for that is because a company like Zipcar is incredibly capital intensive. So when a company needs, a lot of capital to grow, those very early investors and the founders have a big chance of getting extremely diluted. We've seen some other companies like Gilt Group and, other types of companies, in that category that, for example, have grown very large, but, let's say they raised $250 million over the course of, their lifetime. And then even if they exit for $250 million, you're basically not getting any of it because all of those follow-on investors who wrote much larger size checks are going to have, preferences and, all sorts of things that are essentially very likely to diminish the value of your investment. So I'm not saying that it's not possible to do very well investing in a company that has huge capital requirements, but the risk is much higher because, the more the company raises, sort of the more, weight there is on repaying those investors whatever it is they demand, the more at risk you are of having some sort of a down round at some point in the future that can be damaging to early investors. So you want to have a business that's capital efficient. It should also still be attractive to follow-on investors. So you want to make sure that if you're coming into a seed round of $1 million, that within 12 to 18 months, this company may be in the position to be attractive to do a Series A of say $3, $5, $10 million from venture investors who are also going to expect a 10x return or more on their investment. And as we say that. For those future capital requirements, those investors as well are going to expect return multiples of, 10 to 20x. So we want to make sure. Now, for us particularly, we are always looking, when we come in at the seed stage, we're generally looking, for a non-Series A investment for kind of like, I would say between 15 and 30x when a company is just starting. And then as they get closer to Series A, you're kind of looking for maybe a 10x, a later stage Series A, what the company generates substantially more revenue, maybe a 5x. So return multiples, depending on stage, will kind of, in terms of what we're expecting from a company, will go from, 30 to 5, depending on the stage. But for us, we're typically looking for an overall IRR on our portfolio of, around 35%. And that would be between, very early and a little bit more mature, but yet still early stage companies. And then the next thing is, we're always looking to provide diversification. So, when it comes to opportunities that are on the 1000 Angels platform, we try to make sure that you see a lot of different types of companies in different sectors, et cetera. And as you're building your portfolio, you want to make sure that, there is diversification in your portfolio as well. So I want to thank everybody who joined in today. I really appreciate it. And if you're watching on YouTube, don't forget to like, subscribe, and share. And if you're interested in getting involved beyond just the learning stage, but actually writing checks, please go to 1000angels.com and sign up for a free 2-week trial today. And I'll be happy to set up a one-on-one call with you to answer all your questions and see if we can help you with your strategy for building a portfolio of high growth, high quality, early stage investments. So thanks so much. And I'll see you next month where we'll be talking about the investment process. Have a great day.